Hey everyone, welcome back to Crypto Partner Club. I am Mauro Terrinoni, former investment banker and hedge fund analyst. And today we're analyzing how to add crypto to your portfolio, but not in the way you've heard before. In this video, you're going to get three things. First, why the old Bitcoin as a portfolio diversifier thesis is dead, killed by correlation. Second, my two-layer framework, short-term institutional catalysts, plus long-term AI blockchain convergence. And third, why Bitcoin and Ethereum specifically may capture more of this value compared to emerging digital assets. By the end, you'll understand how to allocate a percentage of your portfolio based on conviction, not correlation. So let's dive in. In its early years, Bitcoin was considered a diversifier in a portfolio because it had not exhibited meaningful ties with equities. But since 2020, a significant shift occurred. The relationship between Bitcoin and equities turned positive and has remained so over the last years. In the last year, correlation between Bitcoin and S&P 500 generally stayed between 0.3 and 0.5, and similar values can be observed with Nasdaq. When expanding the timeline over the last 12 months, you will notice that the correlation fluctuates very broadly, but over time the fluctuations become narrower, trending towards a consistent positive correlation pattern between Bitcoin and stocks. Essentially, Bitcoin now trades like a leveraged growth stock, with daily standard deviation roughly 3 to 5 times higher than that of equities. This high volatility suggests that Bitcoin may now serve as a better extension of a portfolio's equity exposure, basically amplifying market movements. The key reason for this positive correlation lies in Bitcoin becoming a mainstream asset and the fact that it has gained popularity with institutional investors and also progressively been allocated as part of mainstream portfolios. The launch of spot ETFs, for example, has positioned Bitcoin as another asset class treated similarly to growth stocks. Asset managers can now bundle Bitcoin with tech equities in growth portfolios without the need for investors to open crypto wallets. The effects of such adoption is that when stocks crash, Bitcoin crashes, and when markets display bullish cycles, Bitcoin follows. So if we're saying that Bitcoin is no longer a hedge against stocks, why invest in Bitcoin and other crypto assets? In my view, the answer is not about portfolio optimization. It's about blockchain as the new core financial infrastructure. Here is my investment thesis. Two layers. Layer 1, short-term catalysts driving 2026-2027 price action. First, spot ETF inflows. $56 billion in Bitcoin ETFs by Q1 2026. Second, corporate treasuries. 172 companies are stacking Bitcoins on their balance sheets. And third, regulatory clarity. The Genius Act that was passed in July 2025 provides stablecoin regulatory framework. And in addition, there's broader market legislation that is advancing through Senate in the US, so-called Clarity Act. These are real tradable flows. You can track ETF flow data. You can watch corporate filings. You can monitor regulatory developments. This is real momentum you can capture. But there's a bigger story. Layer 2, long-term AI and blockchain convergence. AI is the theme of the moment. Everything seems to be obsessed with AI. By 2027, millions of AI agents will be making purchases autonomously. This is Visa's prediction, not mine. And here's the key insight for you. AI agents cannot have bank accounts, but they can have crypto wallets. I will give you three important reasons why AI agents need blockchain. First, micropayments. Credit cards have fixed fees of 30 cents plus. This makes paying AI agent 2 cents to read a news article or performing some admin tasks economically impossible. But stablecoins on layer 2 blockchains cost fractions of a cent, and suddenly micropayments become viable. Second, instant settlement. Banking takes days, and it only operates during business hours. Blockchain conversely takes seconds. AI agents operate 24/7. They need real-time and continuous settlements. Third, permissionless access. You cannot open a bank account for an AI agent, but you can give it a smart wallet with programmable spending limits. That's the new path. This is why Stripe invested over $1 billion in stablecoin infrastructure, why Visa completed hundreds of AI agent transactions in live production. This is why Coinbase launched agentic wallets in February. This isn't speculation, it's infrastructure build-out happening right now. Before we continue, if you're finding this analysis helpful, subscribe. I post weekly videos analyzing crypto through traditional finance frameworks. No type, no paid promotions, just the fundamentals that I used when analyzing investments in my previous jobs. Now, why Bitcoin and Ethereum specifically? The answer is liquidity and trust. Bitcoin daily volumes, about $20 billion. Ethereum, about $10 billion. Solana, roughly $2 billion. Emerging layer 2 tokens, often under $50 million daily traded volume. For macro institutional plays, you need liquidity to enter and exit positions without slippage. You need regulatory clarity. You need ETF accessibility. Bitcoin is the main digital settlement layer and the most secure blockchain. 172 companies hold it on their balance sheets. This is the base layer. Ethereum is the programmable platform. We discussed it in my recent video on Ethereum, where I explain its fundamental purpose. Stablecoins settle on Ethereum. Layer 2 solutions all settle on Ethereum. This is where agentic commerce will run. This is where most smart contracts are executed. Other coins have higher risk, less liquidity, unclear regulatory status. For long-term infrastructure play, you want the core, and that's Bitcoin and Ethereum. So here's the investment framework. Short-term, you have institutional catalysts, ETFs, corporate treasuries, regulatory clarity. Those forces can drive prices in 2026 and 2027. These are tradable themes. Long-term, you have AI and blockchain convergence. Agentic commerce requires blockchain infrastructure. Millions of AI agents transacting in 2027. This is a 5 to 10 year infrastructure build-out. Therefore, this is my allocation recommendation. If you're skeptical, start with 1 to 3%. Simplest would be all Bitcoin via spot ETFs. If you believe in the infrastructure thesis, 3 to 5%. 60% Bitcoin, 40% Ethereum. If you have long-term conviction, 5 to 10%. And then add some layer 2 exposure for potential explosive upside. But let's be clear about the risks. Short-term Bitcoin moves with stocks, not against them. If tech crashes, Bitcoin will likely crash too. This is not a safe haven, and volatility is much bigger than stocks. This is a long-term infrastructure play. You're allocating a portion of your portfolio to gain exposure to blockchain technology that has been built to replace legacy financial systems over the next decades. You're not buying portfolio insurance, you're buying infrastructure exposure for the AI economy. This is the thesis. Quick disclaimer, this video is for informational and educational purposes only. It is not for financial advice. If you need personalized financial advice, please consult a qualified financial advisor. And remember, when investment, capital is at risk. If you found this analysis helpful, hit subscribe. I post weekly videos analyzing crypto through traditional finance frameworks. No hype, no paid promotions, just fundamentals. See you in the next video.